So let me continue. We've discussed who makes money, who doesn't. What about finding trading ideas? Where do we find the trading ideas to begin with? Well, let me give you some examples of the kinds of trades some of the traders that we examined looked at. Foreign exchange was popular, and the reason for that is foreign exchange tends to move in trends, as you can see here, smooth and relatively smooth trends, and it tends to revert around certain prices. It tends not to go on and on and on and on in one direction or the other. So, one characteristic trade we found from a winning trader was they'd look at certain trends, they'd find what the point around which the price was moving, in this case 150, and it's in sterling dollar. So 158 was the break point, 158 the point around which it moved, so $1.58 to the pound. And every time it moved too far below that, they were looking to go long and expecting a reversion back to it, and every time it moved too far above it, they were looking to go short and look for a reversion to the mean. A relatively straightforward strategy, you might say. And the reason behind this is they work on the basis that value, or where 70% of the trades take place, are around that central pivot point. Whenever the price moves too far above value, it's likely to move back down again, or in the opposite direction, moves too far out of value, it's going to move back in again. And that's what they were doing. This was where it's moved too far away from value and likely to come back, and similarly moved too far away from value and likely to move back. How do you know where the value is? Well, you have to, like this, look at the chart and make a decision based on that. This tended to work quite well. They called it the mean reversion line. In other words, the point around which the price tended to move. They then started, let's say in this case, if it moves too far south of that line, they expect it to move up. They started going long, and it might keep on working against them. So they've obviously got to pick a stop loss. And the stop loss for them tended to be calculated thus. If that's point A, their entry, so that's the point at which they decide, right, if it moves a certain distance from the mean reversion line, in this case, this far, then the target is obviously that it'll go back up, and the stop loss is an equidistance from there. So that's the profit, and that'll be the loss. And they think the odds are in their favor anyway, because it should revert back, and that'd be their profit. So the point where they enter is here, maximum stop loss down here, and the profit being from entry to the mean reversion line. Relatively straightforward, simple strategy. How did it work out? Well, this is one account we looked at in 2009 between the 1st and 17th of July, and it was ridiculously successful. This is a live actual account. Total number of trades in that period were 454. Winning trades were 450, losing trades were only 4 based on this strategy. The average returns you can see there. The maximum profit was £500, which is here. It was this trade, you can see there where they made £500, and it was trade number, whatever that is, 260 there. And each one of these bars represents the profit of a particular trade. So this shows how much profit they made on any given trade. So here you can see, for instance, trade number 162 made about £85, £90, and so on. And some of them had what's called overnight funding charges. This particular account was spread betting, and so there's funding charges because of leverage and so on. But essentially this shows these are the trade numbers here. So trade number 1, starting at trade number 1, all the way up to trade over here beyond trade 481. And this is the profits on this axis and how each one of them did. And I said, following that particular strategy, it tended, surprisingly, to do incredibly well. In the next video, I'll discuss another way of finding trades.